Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I haven't had him on in about a year. He made some really interesting predictions about a year ago. He's the principal and chief investment officer at Bulwark Capital Management. He also has a popular podcast on iTunes called Know Your Risk Radio with a lot of great guests like Luke Groman, Lynn Alden, many other macro experts on there. Zach Abraham, thank you for joining me again.
It's good to be back, man. I appreciate it.
So, Zach, we're recording this interview on Thursday, May 15th, 2025. The bond yields are going absolutely bonkers the last couple of months. I think the 10-year US Treasury in the last 3 months has rallied enormously. It hit 4.5%. It's probably the exact opposite of what President Trump and his Treasury Secretary Scott Bessent wanted. Excuse me, the 30-year US Treasury hit almost 5% at 4.9%. I think it dropped. It might have even touched 5% and it just dropped to 4.9 something percent in the last couple of days. I think that's the highest in 20 or 30 years.
Yeah, it's creating a kind of an uncomfortable situation, which is which makes a lot of the movements we're seeing in equity markets even a little more, well, I shouldn't say surprising or head scratching. There have been a lot of head scratching activity in this equity market for quite some time, but it is very odd to see the 10-year and the 30-year pushing up against the same levels that sent the markets reeling. And yet this time they seem to be applauding it. Honestly, I just think that this market is looking at a lot of things that aren't, that aren't fundamental, that aren't real. I think that as crazy as it sounds, when you look at all the flows data, I think retail is just kind of running the ship right now. And it's because if you're paying attention to these things, all you see are, it reminds me a lot of the inverse of the setup of this market going into COVID, meaning, you saw macroeconomic risks from, let's say, 2015 to 2019. But you knew that the central banks were standing there with a hose ready to spray liquidity on every problem. And so it was kind of one of those things where you're like, yeah, you can see a couple problems floating around, but we know what they're going to do. They're just going to drown it out with liquidity. And so every problem you saw really wasn't a problem. And you're like, this is just like this mechanical grind higher. And I just don't see anything stopping it. You flip around today and it's maybe not the perfect inverse, but it's a very, very different setup in the sense that you're pushing extremes on every side. Look at what's going on in the world on a macro basis, and then what we're talking about with yields, right? And yet valuations pushing up. You've got multiples expanding right now with yields rising. It's odd to watch multiples expand while the discount rate is going higher. Especially when you're looking, the other thing to think about as well is here in the US, everybody is kind of treating this like it's COVID, like it's this kind of self-created storm, right? And when you look at what was going on economically, I want to say for the 4 preceding quarters going into this year, on a real basis, you had sequentially lower rates of growth, 4 straight quarters. I think one of them dipped down to 1 and then it jumped back up to 2. So all 4 weren't sequential, but I mean, over the course of 4 quarters, you were steadily moving down. So there kind of feels like there's this, I don't know, feeling in the market that, oh, we're going to deal with the trade deal. Now it's just back to, great guns. And you're looking at them going, guys, whatever trade deal we come to is going to be at least for corporate profits, and stock prices and things like that, whatever trade deal we come to is going to be a less favorable environment than we were prior to this. Like where we were at the fourth quarter of last year. So I think
do you think this is because of the mess that Trump and Bessent inherited from Janet Yellen and all these other administrations with Treasury secretaries in Congress and the White House, that there was just so much can kicking over the last 15 or 20 years that it compounded to this point where there are no good options left to avoid pain with the budget deficits and the trade deficits?
Well, you could. I mean, that's you 100% that this is the result of the can kicking of the last 15 years. And then it happens to, dovetail right into the situation that we were at, which is, you're kind of just as Trump starts taking office, the world starts choking on the amount of especially long dated bonds you've got. And so it does seem like the bill is somewhat coming due. And I think that this is one of the reasons that you haven't heard the Trump administration talk as much about cutting spending. Look, we all know that we have to cut spending and we got to decrease the deficit, right? But when I first heard them talking about cutting 1 to 2, first of all, when I heard them saying they were going to cut 1 to 2 trillion, I love the effort and the approach. It needs to be done. But I think we all knew, anybody with any understanding how these things work was like, there's no way in the world you're cutting that much. And Jason, the basic reason for that, I know you know this, but for the listeners, so if you're running a $7 trillion budget and you cut, let's say $1 trillion, right? What is that? That's about a 13% spending cut, right? Okay. What would the feed over into GDP there? You got to believe that level of spending cut. Now, some of those spending cuts may have somewhat stimulative effects, but you've got to believe that at least on 80 cents of every dollar that they cut in spending I mean, I know it all feeds into GDP, but like really, you got to figure at least 80 cents on the dollar of those spending cuts would be taken right out of GDP.
Well, so unless they cut the GDP formula.
Well, yeah,
they changed the GDP. Yeah, they changed the formula.
And I wouldn't put it past them, right? I mean, if the Fed was in charge of making the GDP formula, we know that's exactly what they do. But when you think about going back to put this in perspective, so if I'm right, and let's say it ended up being 80 cents on the dollar, you'd be looking like an 8 to 9% reduction, like a 9% reduction in GDP. So to put that in perspective, in 0809, the great financial crisis, from the end of 07 to the bottom in 09, GDP dropped by like 3.8%, right? And the market was down 63% top to bottom. So, when I heard him talking about 1 to 2 trillion, I was like, hey guys, that would be great, but you'd be in a depression, right? So you knew they weren't going to be able to cut this much. I think it sounds to me as though they're coming to that realization. And again, you and I'm telling you nothing you know, or nothing you don't know. But if you want to deal with the debt and the deficits, it needs to be done incrementally over long periods of time, or you will. The other thing that you've got to consider too is I think that the economy is more sensitive to spending cuts simply as a byproduct of the fact that deficits make up 7% of GDP. Right. So, historically, we've averaged like 2.5. So at 7, I mean, that's nuts. And then you got to think also what happens to that number in the event of a recession, right? In the event of a recession, the deficit probably goes to 10. And to put that in perspective, you start talking about countries that have 10% deficits. What was the country I was looking at the other day? I'd call it like 2.5 world country. Not a third world country, not quite third world. But anyway, I mean, there's I'm forgetting which we've been looking at so many, but there's a country out there that has got some currency issues. Debt is very much a concern, and they're running a 10% deficit to GDP. We're at 7. I mean, it's pretty crazy. So yeah, you've got to bring that spending down, but you've got to be aware. And you and I both know.
Well, Congress doesn't want to bring the spending down because you've had Rand Paul talk about this. So you have the Trump people saying we're going to cut spending and they're unearthing all this fraud, waste, fraud, corruption, and abuse from Doge, right? But that's on one hand. And on the other hand, it seems Congress wants to raise the debt ceiling by $4 or $5 trillion.
Oh, yeah. Well, I mean, you and I both know, regardless of what they say, Congress never wants to cut. Now, the only reason I think he might get some participation in cutting expenses is because I think the left would love to see this market crash. So and
blame it on Trump for the midterms.
100%. And look, I think that is a bigger threat today than it has ever been. I think that, and I mean, all you have to do is go look at retail market involvement. Go look at retail leverage, retail margin. You've got more people, as a percentage of the overall populace, by far more people focused on the stock market today. And if the market drops in your tenure 30% and you're up for reelection, you're not getting reelected.
You're
Period.
Hoover, yeah.
Yeah. Well, yeah. And I think that's a great analogy, right? With Hoover, he was staring and, he was in the beginning innings of an 85% drawdown. I think 30 to 40 with any amount of direct. Well, I mean, look, I was looking at a tweet the other day from Eric Swalwell, who was saying that the 15%, so the S&P trading down to 23 times earnings. Eric Swalwell was putting out the tweets about your 401k is now a 201k. It, like, people are panicked about 15% pullbacks now. And yeah, it's
People are so used to then the asset price inflation with the positive benefits of the Cantillon effect for the baby boomer generation.
Yeah. Well, and then if you think about it, I mean, inflation has only been pernicious and something that has been part of the zeitgeist for about 3 years. But if you look at asset price inflation, you go back and look at the Fed's calculations, they're going to tell us there was virtually no inflation coming out of 08, 09. Well, okay, what did housing prices in the US do from 2010 to 2020? They weren't flat, right? They were up a good amount. Now they were coming out of a bit of a morass, but I mean, I believe by 2020 we were above the 2007 highs. So, I mean, look at the stock market. Look how much it had gone up. I mean, by the 2020, beginning of 2020, I think the S&P had rallied 360% or something like that off of its '09 levels. So, you may have not seen CPI going higher, but it sure as heck, it was more expensive to live your life in 2020 than it was in 2012. So I mean, yeah, it's a
No,
it's a
let me.
it's yeah.
Can
Go
I
ahead.
ask you then about what you think Trump and Bessent had planned? Do you think they had planned they wanted to refinance the debt at lower interest rates? So they were hoping what the 10 years Treasury would go below 4. They were hoping the long bond, the 30-year Treasury, would be back down to 3. They were hoping to refinance a lot of this debt that was coming due. Do you think that they also wanted, besides refinancing this debt, that they wanted a weaker dollar too?
Yeah, I mean, that was my read into it in the beginning. But then I turn around and watch Trump, cheering people on to buy stocks. And so I'm kind of sitting there going, well, maybe that wasn't their angle. I think their angle, if now, I also think they were trying to thread the needle here, which is usually not a good idea, especially when you're dealing with U.S. debt and government. It can make it extraordinarily hard to thread a needle, if not impossible. But I think what they were trying to do is to come in. I think they probably saw signs of the economy cooling. If you were, that's the other thing that's crazy to me is, again, everybody's acting like the only issue on the table was the trade, the trade war, where there were all sorts of signs of slowing economic growth. I mean, we were watching earnings estimates coming down in the first quarter before the trade war even started. So you were up against it. I think what they were trying to do is, I think that Trump came in and asked the Saudis for help on oil and asked them not to cut back, to keep it pumping, keep that price of oil down around in the 60s range, right? It's kind of a suppressant on inflation. And they probably saw a little bit of cooling in the market. I think they thought those two factors would give the Fed a green light to cut. And then they probably hoped that those cuts would bring down the back end of the curve and allow them to start refinancing more aggressively. But that's why Trump cheering on the stock market and doing all this stuff has been a bit of a head scratcher for me, because it makes these problems much more difficult than as opposed to easy.
And you think that's why? Sorry, let me just
go ahead. Yeah.
Talking about the Fed cutting. So that's why you think Trump was talking about firing Jerome Powell, because Jerome Powell, he doesn't get along with Trump. So yes, Trump appointed Jerome Powell in his first term, but within a couple of months of Trump appointing Powell, basically Trump was already talking about potentially firing him, because people forget that Powell was raising rates a lot during Trump's first term in 2017 and 18. That caused the repo crisis by summer 2019. So they don't get along. From what I've heard, that basically Scott Bessent is the go-between, that Trump and Powell aren't even on speaking terms, and that Bessent and Jerome Powell are the ones who have the meetings a couple times a week. They have breakfast or lunch, and they meet in person, and Bessent relays the stuff that Trump says. That's what I've heard.
You know what? I hope that is the case. And the reason I hope that is the case is I understand where Trump is coming from, because look, I understand why the Fed isn't cutting right now, but I think it's very hard to look at the Fed and exonerate them in total from, from being political, right? And the reason I say that is I think it's very hard to make the argument that the Fed does not have more ammunition to cut today than when they first started cutting, right? Now, I understand why they haven't, and I don't completely disagree with them, but I also think that there is enough there if you're sitting in Trump's shoes going, wait a second, what's going on here? Now,
well, they cut rate 75 basis points a couple of months before the November election, so I would argue that that was political. Now, they use data to try to justify those rate cuts, but it caused inflation again, and I think it was to juice the stock market and help Biden and Kamala Harris to try to get elected. So I think that was political. My opinion is that the reason Powell's not cutting rates right now, and yes, they can use data to justify this, but honestly, he hates Trump. He's not going to help him.
Well, and that was my point. I think that where I think the best evidence that there is politics baked in the Fed's decision is not just that they cut prior to the election, but that they haven't cut now, right? Meaning,
yeah, I agree.
If you go back and listen to the reasons they were cutting then, and all of those reasons are more pernicious and more pronounced today than they were then.
And the op-eds from the Fed governors and the ones that just left the Fed in the last couple of years are all never Trumpers. So they're all like, Trump's going to ruin the economy, Trump's tariffs. They're all like, we can't elect Trump. So a lot of current and former Fed governors, in my opinion, are rich Democrats and never Trumpers.
Now, yes. Now, the one thing I will say is I'm not entirely sure that Trump is justified in being angry about it. And I think that inadvertently, look, I don't know Powell. I think he is a far more capable head of the Fed than Yellen. I think he's far more capable than Bernanke. So I actually think he's done a pretty good job. But the other side of it is this. If the goal is to get the back end of the curve down, I'm not so sure a cut does that. If you cut, it's entirely possible the back end could go higher.
You mean the 30-year, so the long bond?
Yes. Yeah. And so I actually think if now I could be wrong, but if my sole goal, if I was in Trump's shoes and my sole goal was to get the back end of the curve down or to keep it in check, what I would want to see first is I would want to see the Fed cutting aggressively, but on news of economic weakness first. I think if they preemptively cut right here, there is a good possibility that now, obviously, you and I know the front end is going to go down, right? It's locked in with the Fed funds rate. But on the back end, I would be, and look, we pulled up a chart and we were looking at words coming out of the White House and the administration, and we were tracking it with yields. Every single time anything sounded somewhat profligate, right? Like, cutting taxes, cutting rates, doing something like that, you'd see the back end start drifting higher, right?
You're saying that the bond yields are rising on the 10-year, 20-year, 30-year. They're not rising because the U.S. economy is doing well, that it's a pro-growth, pro-inflation story, that you're saying that it's foreigners that are looking at all the U.S. government finances with the budget deficits, the interest payments, and saying there's a dollar debasement risk, a bad inflation or stagflation risk, and so that's why yields are rising then?
Yeah, I think it's twofold. I think it's that. And then I also think that has been exacerbated. Look, the bottom line is you start this kind of tariff trade war, we got to see where it filters out. But bottom line is the world will be in a less cooperative place than it was before. What does that mean? Well, now we turn our eyes over here and look at the US stock market, and I'm not exactly sure where it's at right now. It's really close, but at the peak going into this year, it was just shy of 70% of global market capitalization was the S&P 500. So our market was it was worth 70% of the entire global market capitalization, even though our economy is responsible for about 20% of the GDP. That, if anybody's
Disproportionate.
wondering,
Yeah, that's very
yeah,
disproportionate.
it is a record too. We have never been close to this level. To put it into context, if you go back, probably the best comp to that anywhere, in financial history over the last 100 years was probably Japan in the late 80s, right? And Japan was so overblown in the late 80s. At one point, the land underneath the Imperial Palace was worth more than the state of California. Okay,
Yeah,
so
it sounds ridiculous.
yeah, I mean, well, because I mean, right, it was like the stock market that couldn't stop, and so all of this foreign money had flown into it. Okay, so now when Japan reached its zenith, or when the Nikkei reached its zenith, it was right around 41,000, I believe 89.90 is when it topped out. But it was trading at a 103 CAPE ratio, cyclically adjusted PE ratio. Right now in the US, we're like at 33, 34. So it tells you how insanely overcrowded it was. Even in that environment, the biggest their market ever got was 39% of global market capitalization. We're at 70. Now, we're a bigger company, we're a bigger country with a bigger economy, but still, when you make up 20% of the world's GDP and you're 70% of the market cap, you have become home to virtually you have become the number one, every single portfolio around the world is US equity dominated. And
Yep.
so to a level that we have never seen. No market has ever been that dominant as far as market capitalization level. So what I think's happening when you start getting a less cooperative world and you start all of a sudden becoming, the other thing you got to think about is it looks a lot like the dollar has topped here, right? Go and look at the DXY. Remember, for a lot of years, like over the last 15 years, international investors weren't just putting their money here because they believe in US equities and think they're superior. I mean, they are. We have a better market. But it was also, if you buy a pot of US equities and they drop by 20% over the same period of time, your currency sells off 30% against the US dollar, you're a winner, right? So all of these reasons to expatriate your money to the United States, they haven't gone away, but a lot of them are reversed. Now, all of a sudden, you're looking at the dollar and it looks like it looks like the top is in, for sure. It looks like that top is in. I'd be shocked if we cross over 117 on the DXY where that top was, 2 years ago or wherever it was. Not saying it's impossible, but I mean, I believe the top is in. So you're looking at it being the most crowded market ever in the history of markets on a global basis. It looks like that currency has peaked out, especially against emerging market currencies and things like that. You've got, the wheels are starting to shake a little bit with all the debt. You're running 7% deficits. All of those factors that were serving like a magnet for international capital, I think at the very least, they are much less pronounced reasons to put your money here. And a lot of those factors have flat out reversed. So I think it is concerns about our situation, our budget situation, our debt situation, and deficit situation. But the other side is when I see a market, when I see the dollar down, stocks down, and bonds down, you know what that tells me? Tells me people are liquidating. Tells me foreigners are liquidating. And so I think the outflows have begun. I don't think it's going to collapse the U.S. stock market, but I would expect over the next 3 to 5 years, I will be shocked if the U.S. is even in the top 5 in terms of performance of individual countries. And that just kind of comes down to a flows story and a valuation story. I mean, anybody that's done any fundamental work on, go pick out good countries to do, the countries out there that you would feel comfortable putting capital into, and then go out and look at their sectors and pick out, as best you can, counterparts to U.S. equities. Okay, what you're going to find, typically speaking, is a bunch of companies that are growing at faster rates, have cleaner balance sheets, and are trading somewhere between 1/4 to 1/6 the valuation of their US counterparts. So I think that has also occurred, right? Like, and you and I both know when you see these reflexive cycles, like, everybody's putting money in the US because the US stock market's going up, and the US stock market's going up because everybody's putting money in the US. It's almost impossible to predict when those reflexive cycles are going to end. But when they do, it's usually kind of quiet, and it kind of gathers momentum over time. And eventually people kind of start waking up to it. One of the things, and you can see this, you can hear it in investors talk, less on the retail side, obviously. They're too busy chasing Palantir and Carvana. But certainly on the professional side, I think that this need to expatriate capital out of the US, which I think has been a big reason for, again, stocks, bonds, and the dollar selling off all at the same time. And I think the other thing that's happened in that process is people have woken up and went, wait a second, look at the valuations out here, and I'm not talking just like really sexy tech stuff. I'm talking about like consumer staple type companies. You look around the world, and if you didn't know any better and you started comparing really solid international companies with US counterparts, you would think there was something about the US that made your company 4 to 5 times more profitable. Now, do US markets and US securities deserve a premium? Maybe 25, 35%? Sure. But 4x, 5, 6x? I mean, you've gotten to a point of insanity. And, when you and I were coming up in this business, every portfolio was diversified and included international equities. I don't know when the last time you went through a 401k investment allocation, investment options. I can't tell you the last time that I saw the investment options inside of a 401k have anything that was somewhat compelling that was focused on stocks outside the US.
Oh, yeah. And I'm running into people, Zach, I don't know about you. I'm running into people that tell me that they're diversified because they own Bitcoin, a few other cryptos, and then the Mag 7, NVIDIA, and a few other tech stocks. And that's diversified and in bragging how well they're doing.
Oh, yeah. No, it's 100%. And I just think, look, there have been so many, false tops. There have been so many false calls for the reversal into value. And I very, very, very much believe that is the place we are. I very much believe it is time to trim U.S. exposure big time, especially to stuff that is priced at a level that doesn't make sense. And then just go out there and look. The analogy we used going into the year was, look, I think the markets are presenting you with a choice. Okay. And the analogy we used for that choice was, it's like you're at a fair and there's a guy with a boxing ring, right? He's offering you $1 million. And it's like, okay, I'm going to give you the chance. You got 2 guys to pick from that you have to fight. Regardless of how the fight ends, you got to stay in it. You can't throw in the towel. But regardless of how the fight ends, as long as you don't throw in the towel and don't quit, you're going to get $1 million. You're like, okay, fair enough. Who am I picking between? And he's like, okay, the 2 guys you got to choose between who you want to fight are Mike Tyson and Steve Urkel. Who do you want to fight? And you're like, well, I'll take Steve Urkel. To me, everybody chasing U.S. equities right now in this environment, to me, is picking Mike Tyson. Okay, where I flip around.
I mean, Mike Tyson might be bought. It looked like on the last Netflix one that the whole thing was staged.
yeah. Well, there's that too. Yeah. So maybe you're Jake Paul or whatever his name was. Yeah, maybe you got it rigged. My point was, though, is that there comes a point, and here's another good example of this. We were looking internationally, and we bumped into a Panamanian airline company. Reason Panama is attractive to me is because it's a dollarized system. So, internationally speaking, I think it's probably one of the safest locales to park money internationally. It's also the gateway to Latin America. We're really excited about the next 10 years, the potential of the next 10 years in Latin America. And if the next 10 years are good, the next 10 after that will probably be really good too. So I think there's incredible potential down there. But you've got this airline that has no pension liabilities whatsoever. It's growing at about 15% a year. It's incredibly profitable. They have net cash on their balance sheet, which is kind of an oddity for an airline company. And they're paying a 6.5% dividend. And they are, let's see, like I said, revenues are growing about 15% a year. And the stock is trading at 6 times earnings. Okay, flip around and go look at Alaska Airlines. You know, in no financial metric is it better, and yet it's running around at 24, 25 times earnings. An airline company,
And you
right?
have other airlines going bankrupt too.
Yeah, trading at like 5 times the value, right? Being an airline, and the reason I think this is such a good comp is the airline business is the airline business is the airline business. They have the same cost constraints. They've got the same issues finding employees. It's all about lowest cost per person that you're carrying on your airplane, right? Could you make the argument that a US based airline company, versus a Panamanian one deserves a premium? Like I said, yes, but 6x, 5x the valuation, that's insanity. And then you turn around and you look at the one that we bought. That airline company we bought out of Panama was trading at 80% of asset value, right? I mean, that's how cheap it was, right? And people are like,
So that's
how do
like
you know
old
that?
Benjamin Graham stock liquidation value is more
Oh,
than the market cap.
oh yeah. Yeah. And you're growing 15% a year, and you've got net cash, and they're paying you 6.5% to sit there and hold it. Like, that's fighting Steve Urkel, man. Right? Like, I can just sit on that stock for the next 5 years, not get any underlying growth on the stock price, and I'm going to be sitting pretty.
Sounds like you found a good undervalued growth stock, but meanwhile, a lot of the airline industry in the United States, higher costs, pension fund liabilities, like you said, the workers just went on the airline pilots and the airline workers went on strike and the airport workers went on strike, and you have all these government regulatory agencies with compliance, and when an airline's about to go bankrupt, you have to get approval from a government agency for a merger to save an airline. Even though it's about to go bankrupt, they still have to get government approval to save the airline.
Yeah. So another crazy one. We found an international trade finance bank, a Latin American. So basically, the number one, the duration on their book, I want to say on average is like 16 months or something like that, right? It's trade finance, so it's very short term stuff. But this thing, it is becoming their board of directors has a central bank member from virtually every Latin American country. Okay. So unbelievable connections. And they're growing at like 30 to 40% a year. They've become the go-to bank in Latin America for trade finance. They're trading at 7 times earnings, growing at 30 to 40% a year. If all you did was make that a US based corporation or US domiciled corporation, the stock could go up 4x immediately.
But if you're a money manager, though, and those countries act like an emerging market and you don't have exposure to Mag 7 and NVIDIA, like, you potentially career risk, you could get fired. So that's like the issue with the whole financial industry. Like, you're picking out good undervalued growth stocks in other countries, but a lot of mainstream money managers, I mean, if they don't have exposure to NVIDIA, Mag 7, S&P 500, NASDAQ 100, they're potentially career risk looking at getting fired. That's how bad the industry is right now.
Oh, no. And hey, look, we face the same risks too. But the flip side is, though, the fund that I run is up about 8% on the year. And it is not from any of that stuff, right? It's and to be clear, I wish I could tell you there were some really sexy, really cool trades. There haven't been. It's just been being long international value. Gold and gold stocks have helped out a lot this year, kind of along the same lines of thought. I agree with you, but I do think that everybody is acting as if nothing has changed, and I think a lot has changed. I think that even Mag 7 has got considerably more headwinds than it's had at any other time. I think you're going to hear, unless the Trump administration intervenes, I think you're probably going to hear more antitrust things brought up against Mag 7 type companies. I think in the case of Google, those fears are overbaked. I think in the case of a company like Apple, they don't take those fears seriously enough. But yeah, I just, again, markets can stay irrational longer than you can stay solvent. And I know you take a risk making that jump. But the one thing I will say, and this is what I've told our people and I've even told our clients, I'd be lying to you if I told you that that risk you just brought up didn't concern me, right? I'm exposed to that risk too. And even if the clients tell you, Zach, we're on board, we think that's the most prudent thing. You know, if I'm down 6% and the S&P's up 20 this year, I'm going to lose some clients, right? There's no question about that.
Well, look
But
at
I
Einhorn.
do,
Einhorn's lost a lot of assets under management, even though he's picked out a lot of winning stocks over the years. And now he's warning people that, like, with the budget deficits, that people need more gold exposure. I think he just said, like, he could see gold at $4,000 an ounce soon. Ray Dalio just put out a YouTube video saying that, like, silver could go up 10x and that gold prices are going to go a lot higher. So, I mean, you're starting to get warnings. I think the macro trade, Zach, and you're talking about the asset price valuations, that it looks like nothing's wrong based on the U.S. stock market, the S&P 500, the NASDAQ 100, Mag 7, Bitcoin prices. Looks like nothing's wrong. That risk is on. Beneath the surface, I think there's a huge macro trade here the last couple of years that a lot of these foreign governments, foreign central banks, they do not want to be net buyers of treasuries. And so they're accumulating each month gold tonnage instead. I think that that's the macro trade and why the gold price is up despite all these other issues with, like, the bond yields and other stuff that in the past maybe gold would not have done well.
yeah, well, I agree with everything you said. The one difference I would say is I think the biggest driver of gold thus far, and it's funny because it doesn't usually happen like this, but that's typical of most things in the cycle. It's been like reversed. But the biggest driver of gold prices has been central banks, right? Buying it. And they have to buy it. If you look at where the dollar is, you look at the risks we're talking about to the long end of the curve, long date, US duration. And then the fact that they've got to de-dollarize to some amount to offset tariffs and increase all the things that are going on around the world. If you're and when I say de-dollarize, they're not going to dump all their dollars. But when you look at the world today and what is going on, or even look at a chart of the DXY, I think it's a hard case to make that every central bank around the world shouldn't take, 15 to 20% of their dollar holdings and diversify it, right?
Agreed.
Okay, well, if that's what you're going to do, and you're just going to take 15 to 20% of your dollar holdings and diversify it, where are you going to put it? The only place to put it's gold. Right,
Yeah,
because
there's not like a larger Eurobond system. So Martin
no,
Armstrong's talk about this, where, like, he wanted a centralized Eurobond system that could soak up some of those foreign exchange reserves and trade surpluses instead of treasuries. There's not one of those. So what other market, like you said, is liquid and large enough besides the US Treasury bond market? The other issue here, Zach, and I think we're 3 full years now, over 3 years post Russia sanctions. I think that was things were already happening to an extent where other countries were moving away from treasuries and gold and buying gold. I think the Russia sanctions were the final, like, nail in the coffin, that these other countries saw that, like, 50 billion a year in interest payments on their treasury debt, 300 billion of reserve assets could be frozen. They just said, you know what? Both political parties can change the rules on us, Congress, White House. We're not going to be buying treasuries at anywhere near the pace of the past. I think the Russia sanctions were kind of the final nail in the coffin. And if you look at the monthly gold tonnage purchases post Russia sanctions, they've about doubled. So the amount was high before the Russia sanctions, and the amount each month afterwards has doubled.
yeah, well, the Russian sanctions and 7% deficits, right? And to go to your point, it's one of the things that fascinate me about markets, right? Prior to COVID, everybody had a theory, but when you looked out at the world, you could not see any immediate impetus that would require investors to divest of US assets and start moving them abroad. Okay? You look at the world today, and virtually all of those factors have reversed. We were talking about reasons why you need to divest from the US. We hadn't even mentioned the whole Russia thing. There's another reason, right? And so literally, they've got to. Then you think about the position that those US dollars played on their balance sheet. That was the no stress part of the balance sheet, right? That's the break glass if fire. That is the asset on the central bank's balance sheet that was seen as having the least amount of counterparty risk. So whatever divestment you're going to make out of US assets, you naturally have to put it in. And if you're looking for something that is more safe than the dollar, there's only one major central bank asset out there that has no counterparty risk, and that's gold. So I see the bid coming into gold from the central banks. I think the retail investors and the regular citizens buying gold in China and India has certainly helped. But we haven't even started retail buying gold or even gold miner stocks here in the US. So, I hear a lot of talk about, oh, gold's gone really high. I look at this situation. I think we're middle of the first, beginning of the second inning on the gold thing. So
Yeah, I agree. I think it's pretty early. We're just starting and we were talking before we started recording. I think the gold miners, the gold royalty companies, it's basically the only industry out there that has sizable free cash flow growth. So if you're a generalist money manager, you're a hedge fund manager, you're checking your Bloomberg terminal screen for industry for earnings calls, what industries have the free cash flow growth? Well, guess what? It's actually gold miners and gold stocks. The energy prices are not rallying enormously. Profit margins are good. Yes, gold prices are down a little bit, but these profit margins are very, very healthy. The industry has a lot of cash flow for the first time in a long time.
And it's so cheap, meaning, go look at the price. This isn't a perfect comp, but I just for the casual listener, I think gives a good amount of context. Okay. In 2011, when gold peaked out at around 1930 an ounce, the GDX was trading at like 60. Okay. Today, you've got gold at 32, 3,300 an ounce, and GDX is trading 46. Okay. With gold at 2,500, the miners are really cheap. With gold at 2,500 an ounce, you've got an average profit margin in the industry of about 40%. At 2,500 an ounce, you're going to see major operators this year. And we saw a couple last year. I said it last year. Everybody's like, oh, no way, whatever, But you're going to see again. You're going to see gold mining companies, major operators. Now, you're going to have some that aren't good that won't do this. I'm not saying everyone will. But you're going to see a lot of big, solid, reputable gold mining companies throwing up margins of 50, 60, 70% this year. And no one cares. It really is remarkable. I've said over and over, the only value opportunity I have ever seen like this in terms of something trading so cheap to its cash flow are energy stocks coming out of COVID. Other than that, to pass up on gold miners here, and this goes back to my Mike Tyson, Steve Urkel analogy too. To pass up on gold miners here, maybe you hate gold or whatever, fine. But if to pass up on gold miners here, I think that you're kind of making an assertion that you truly do not think cash flows matter in investing anymore.
Well, I'll tell you, even if the retail investors and the pension funds don't buy the gold stocks, I'll tell you the industry is running the numbers and they're looking at mergers and acquisitions because you're starting to see a lot of bids for a lot of mergers and acquisitions now.
Yeah, well, and I mean, and I'll tell you as a guy that's watched that industry for a long time, you're seeing a lot compared to where it was a year or two ago. Even that is super early innings. I mean, it's not getting the merger and acquisition space in that industry, in that sector is not at all bustling. Now, you and I both know too, compared to 3 or 4 years ago, it is because it was freaking dead, right?
Well, they were trying to do mergers to survive, like during the bear market in 2015, 16, 17. They were like, there was no capital available for a lot of the companies. So it was mergers for survival. Now they're running the free cash flow numbers. They're looking at discounted assets, which assets are cheap, which ones can we buy that, let's say, Equinox Gold, they're buying a mine that's already under construction now. And the merger just went through. So it's in Canada. The mine's going to come online in the not too distant future. They went and bought the asset before the value was re-rated. The valuation went higher.
Yeah, and no one's paying attention. There's so many cheap assets out there. The other thing that they're going to do too is, if people don't like their stock, they'll buy it back. And I mean, you've got the amount of cash flow. Talk about a perfect setup for buybacks. Because not only are you drowning in cash, but your equities are ridiculously low, right? And then a lot of those companies are kicking out of dividends. You got to remember every single stock, every single share they buy back, they no longer have to pay the dividend on that. So cash flows start looking better going out into the future. When you go do the numbers, I know these guys have limits, but I mean, I think you're going to see some of these companies buy back 25, 40% of their outstanding stock.
I think one of them you've already seen, Sandstorm Gold already bought back about
Yep.
5 million shares in share buybacks with free cash flow just in the last like 4 or 5 months. And if the stock dips more, I think they'll buy back even more.
Yeah. Well, and wait till, like I said, the earnings, the earnings are coming in. And these guys have faced another analogy that is similar to the oil mine or the oil producers. Um, Now, if not everybody has gotten religion, if you want to know what I'm talking about, go back and listen to the last two conference calls that Newmont put out. There continue to be some of these gold producers that are just the thing that they exhibit the highest level of expertise is just stepping on their own feet.
Well, they're too
They
big. Would you say,
Yeah.
because you have gold mining industry expertise for listeners out there, Zach grew up in this business, his parents and family members were in gold mining. Would you say that like Barrick Gold and Newmont Mining, they've gotten too big to the point where they're producing what 5 million ounces of gold a year and a lot of copper that, well, they're looking like, how can we grow? How can we grow efficiently? The numbers just don't work for them trying to get to 6 million, 7 million ounces. They can't do it efficiently without their costs keep rising astronomically higher.
Yeah, and I will tell you this too, as a as somebody that's been around that industry a long time, the sweet spot. Look, this has always been the sweet spot for stocks, meaning the best performing sector of stocks has been small cap value, going back, for 90 years. I think you got like an average annualized return of like 15.5% compared to the S&P at like 11.5. You want to keep that in mind when you're looking at the gold mining space, because there's a practical when you're around the mining world, they are too big. And when you get that big, you need to have stellar operators on site at the locations all the time, keeping a just tight fist on cost controls. And that is for whatever reason, that is the opposite of the way so much of the industry thinks. I
Well,
mean,
they hired, did you see during the pandemic, Newmont hired a bunch of ESG and DEI hires for six-figure vice presidents. So they did the
yeah,
opposite of what you just said. They added a bunch of people onto the payroll, basically doing nothing at mining operations that were making hundreds of thousands of dollars a year with stock options.
yeah. Before I would have told you Barrick is the worst offender. Barrick's actually gotten better. It's not anything we'd buy or own, just because I think there's so many more compelling things to own out there. But Newmont is just, yeah, they're ridiculous. Newmont to me is like the poster child for why people don't like miners. Okay, now that being said, and everybody just keeps saying that they're a horrible business. They're a horrible business. Okay, well, when a business has the ability to cash flow you 30 to 40% of its market cap in year one, it doesn't need to be that good of a business, right? The warts on that business are more than represented in its current price. And it reminds me of what Buffett says, right? There's no bad assets, just bad prices. The gold mining now, am I going to be nearly as excited when these things are, and some of the PE ratios on these things look high, but you've got to factor in the next couple quarters, at $2,800 gold, give it a discount.
Well, let me
And
also, I got a listener question. I'll interrupt you. I got a listener question. The guy was rude, but he asked about price to earnings ratios for mining companies. The industry doesn't use price to earnings. The industry uses cash flow multiples, operating cash flow multiples, free cash flow yield. They look at those things, net asset value. So the industry does not use price to earnings ratios. If they're doing an acquisition, they're looking at net asset value, operating cash flow multiple, free cash flow yield, those types of things.
yeah, I look at the price to earnings ratio. I think the industry looks at a lot of things that they shouldn't look at as investors. Price to earnings rate. Look, the price to earnings multiple is not. It's one of probably 10 different ways that we look to assess what a company is worth, right? Because there can be so much noise in price to earnings multiples. That being said, if we're trying to relay it to the average listener, I mean, we could sit there and talk about free cash flows. We could talk about recovery rates. We could talk about all that kind of stuff. Problem is, it doesn't mean anything to anybody. Nobody knows what the hell you're talking about. And that's the other thing I'd look at the industry. You want to talk about an industry that is horrific at messaging and horrific at telling their story. I think the gold industry should be less concerned about what they do and more concerned about what everybody else does, because they have been the worst PR possible for themselves. And they need to figure out a way to make themselves more marketable to mainstream investors. Now, look, the other side of it is too is, hey, just handle your business, produce the results, and the stock price will take care of itself. But I mean, I do think they need to do some PR work because there's so much negativity around those names. But like I said, you get back to what Buffett was talking about, which is no bad assets, just bad prices. And if you're going to be throwing off that kind of cash flow, the other thing I'm surprised by is that I'll tell you what, if we managed more money than we did, I would love nothing more than to throw 2 or 3 billion into a vehicle and go buy up pieces of this. And then even some of the smaller mining companies out there, some of them, have some issues or whatever, go out there and buy them and take them private and just live off the cash flow. If the market doesn't want to pay up for it, fine. But the cash flows on this stuff is just ridiculous. And as crazy as it sounds to say this, for a lot of ways, I do think that we're on the cusp of cash flows being important again. So that's my feeling.
I hope you're right. I think also, let me add that I think with the generalist investor and value investing, and also with the banks with funding, there's an anti-mining and anti-conventional energy. So oil, natural gas, coal bias. And it's been this way for the last 10 or 15 years that value investors, they don't want to touch these commodity businesses, whether it's gold mining, copper mining, oil, natural gas, coal. A lot of value investors don't want to touch those. And then because of ESG, the banks and a lot of other pension funds wanted nothing to do with any of these companies. Meanwhile, these companies are required to run the economy. China was locking up long-term research deals in a lot of different countries. So the valuations and the quality of some of these assets are really deeply discounted, and they're very, very good. I think sentiment-wise, Zach, we're at a 20-year negativity low for oil now for the oil companies. It's that bad.
Yeah, and that's another one. The way that we've been describing it is, I don't think it's time to go all in on oil. What I do think it is, though, is it is time to we pulled back on our oil holdings pretty aggressively when oil was still around 85, 90. We kept our favorites, but sized them down a little bit. We had some concerns about the price. I think it's ended up being a better move than we thought it would be at the time. At the time, I didn't think you were going to be looking at $60 oil, but nonetheless, that's where we ended up. But I do think it is time to start buying some of these, especially in the mid and small cap range. Once again, these things are trading as if people think, that we're about to go into COVID again. Not quite that cheap, but I mean, pretty ridiculously cheap.
And we're at the cost of production. Are we right at the cost of production now for a lot of West Texas Intermediate?
Yes. Yep. That's the number. The cost numbers are more noisy than people would have you believe. But interestingly enough, you are at that level, and I think because of that, if this price stays here, and you saw some rallies based on the trade news, or again, I think that's people missing the forest for the trees. Oil is where it's at right now because the economy is softening. And OPEC, I believe, in an effort to do Donald Trump a solid, hasn't cut where they normally would have. And so I think that's the biggest. I think that's the biggest depressant on the oil market right now. But I think it is absolutely time to start building positions in some of those smaller names that have really gotten beat up. Some of the bigger cap ones that are really good companies still, they have not taken nearly as big a hit as some of the mid and small cap ones, but we have started adding to some of our mid and small cap favorite names because they just got back down to levels that aren't economical anymore.
And we're seeing behavior from these companies with the earnings calls and their announcements for Q1 2025 that indicate that either they're preparing for a bear market or we're going to have a bottom in the oil price in the next couple quarters. I don't know if it's 2, 3, 4 quarters, but in the not too distant future, because like I said, I think we're at the cost of production. With the earnings calls from the Permian Basin operators, there was comments from the Diamondback Energy CEO, but also like a lot of these Permian Basin companies, which have the oil had the oil production growth the last 15 years, Zach, they're announcing huge capex cuts, 9 figures, so $100 million or more in cuts in investments for oil, natural gas drilling, exploration. This will eventually restrict future supply in the near future.
Yep. Well, so here's the other thing that gets us excited, and this is something that I haven't heard anybody talk about. if oil stays around these levels and you see some production cuts here in US producers, especially in the shale fields, um, it's not a great sign in the oil world, other than when you start seeing production cuts, you're starting to get close to the end of the bottom. But so much natural gas production comes off as just a byproduct of the shale oil production. So as you see, and remember, the shale is the most price sensitive. So those are the first wells to get shut off. Right at the time that all of this need, we were talking about the need for nat gas and people coming after nat gas exporters. So I am long-term excited about oil, or I'm getting excited about it. But I'm very, very interested in nat gas here, because all arrows point to nat gas being in a long-term bull market. And it makes perfect sense, right? We've known for a long time that, you've got this spread between what nat gas costs you in North America and what it costs you in Europe and around the rest of the world. And the spread is just insane. I mean, I can't think of another commodity that compares to it, right? And so you knew at some point, you had to get, you had to get better means of shipping LNG and all that other kind of stuff. But you knew at some point, maybe it was 5 years, maybe it was 20, that those prices had to come, they had to come in, right? You had to close that gap. And I think that process has already begun. And you and I were talking about the needs for nat gas for data centers. People starting to sound a little bit more sane on the climate side of things, realizing that nat gas is not an enemy; it's a friend, right? It should be seen as a friend. It's a wonderful transitional source. So I look at nat gas. I am more excited about nat gas than I am oil, and I think you can make an argument that people are sleeping on nat gas to the same level they're sleeping on gold. It's almost like they forgot it existed. So there's some, the other thing too, you want to go find, I mean, you can find it in oil, but you go out and find some of these nat gas companies we own. First of all, we have found some incredible companies that are outstanding operators. And, we've got one that's paying us, I kid you not, clean. Balance sheet is pristine, phenomenally managed. And they were drowning in cash flow, so they kept boosting their dividend. Still, they bought back as much stock as regulators would let them. Then with the excess cash flow, they started boosting their dividend. Nobody cares. They're paying us 13%. 13%. And the thing is trading at, and people go, oh, well, that means it's in trouble. I know. That's what we thought when we first looked at it. We started doing the work on it. We're like, no, this thing isn't in trouble at all. Just nobody wants to own this kind of stock.
Was it a Canadian company and not a lot of liquidity for trading?
No, no, no. I mean, it's big enough to get in our portfolio. It's actually a US based company. I can't say the name for regulatory reasons, but it's a US based operator. And it's not super liquid. So, I mean, if you ran a $10 billion fund and you were trying to get a position, but the portfolio we're working with is 500 million. And we were able to get we didn't go in there and splash the pot, right? It wasn't like buying Apple. But I think it only took us like 3 days to build the position. So, as opposed to, now this is another reason why we've been telling people to move internationally and just diversify. You want to talk about hard to get into things? Try getting any decent money into some of these international markets. And people are like, Zach, why is that exciting to you? And I'm like, because when you can't get, when you got spreads like that, and a $500 million portfolio isn't huge, but that is not a portfolio that you'd consider has size constraints, right? Like we got to keep an eye on things, but it's not like we're Buffett. You know what I mean? It's not like Berkshire Hathaway. So you should be able to get in and out of things pretty easily. But you look at so many of these foreign country markets. I mean, we have been trying to build positions in some of these things for a month. And that's how thinly they're traded. And why that gets so exciting is that tells you no money is there. There's no money in those markets. So what did we all acknowledge? What's one of the biggest reasons that the S&P is where it is today? Flows. Well, think about how much money is in concentrated markets, or has concentrated in US markets. And if and this is already starting, which is why you see a country like Poland up 40% on the year. Go look at the list of international companies. One of the reasons they're up is just because people were divesting a little bit of US assets and putting a little bit of money into these other markets. And those markets have no liquidity. And so they're just boom, they're just like, like rocket ships. The crazy thing is you go look at those same markets that are up 20, 30% on the year, they're still trading at single digit PEs on the market proper. You start digging into the individual names and you can find stuff trading at 4, 5, 6 times earnings. Find stuff trading at a 20% discount to net asset value. And we're talking about good companies with really good balance sheets that are growing. So I just think I literally think that you have a generational opportunity to start building positions in emerging markets and international companies. And it has been a long, long time. The last time you saw a good run in emerging markets was coming out of the GFC, right? That was it.
Yeah, China stimulus, because China,
Yep.
people were buying Chinese companies, people were buying
Yep.
commodities, anything that was tied to the China growth story.
Yeah, and they've done nothing since. And so then let's take a step back and look at the macro world. What did I just say? I thought the top is in on the dollar. If that is true, extraordinarily bullish for emerging markets, right? We're looking at $60 oil, extraordinarily bullish for emerging markets. You just start, then you look at the underlying markets, how they've performed. It's been a death march. These markets have done horribly over the last 10 years.
I would also say a weaker dollar, to add your points there. I think a weaker dollar index heading towards the low end of the range is also good for emerging markets too.
Oh, absolutely. It's a tax cut, right? The ironic thing is that a lot of those same things can also be beneficial for large US tech. As much as I hate to say that, right?
Well, tech adapts well. They have tons of cash flow and they have control over both political parties with lobbying. So
yeah, but what I'm saying is a falling dollar helps them as well. So added on to their list of advantages, like you mentioned. But so we're not saying at all to divest from just US assets writ large. For instance, we still own Google. I know the fears around Google. I think they're way more than priced in. But then you flip around, you go look at a company. Funny story today. So Alibaba got hit. They had an earnings miss. Everybody, the headline was they had a top and bottom line miss. Okay, the top line missed by a fraction. I mean, it was basically right in there in expectations. And then due to tariffs and other complications, they did take a significant hit on the earnings side. But it should be kind of a one-off, all right? Their stock sold off 7%, but revenues were up 36% year over year. Now, they came into this quarter trading at like 17 times earnings. Had Apple posted that same Q, Apple trading at 33 times earnings probably would have rallied 25%. Okay? Now, Alibaba reports those results trading at 18 times earnings and the stock takes a 7% hit. There is so much BS and froth built into so many of these US names. Like you look at Apple, right? Like can someone, and we could go down the list, Costco, Tesla, Palantir. They're all over the place, but Apple's a really interesting one. Explain to me why that's trading where it's at, why it's got the valuation. I think they're done, but not done as in they're going away, but I think they peaked. I think they're probably going to grow in line with inflation going forward if they do that. Go look at their numbers in China. It's just, everybody's like, oh yeah, well, as soon as the trade war is over, things will be back, normal for Apple. That's not the case. Go look at their numbers from fourth quarter of last year in China, which is their second biggest market.
They stopped growing like 2 years ago, right? They're not really growing anymore.
No, and then the other thing that everybody missed on that earnings call from Apple, it wasn't just the iPhones that missed, right? They actually had a decent quarter because they were front running the tariffs. Their services revenue missed. Like that's supposed to be the growth, right? So, and now you turn around and Apple's still trading at 33 times earnings, growing at 4% and losing market share constantly and negative sales, rapidly declining market share in their second largest market. I think a lot of people own a lot of overpriced US assets right now, and I don't think anybody's doing the homework on them and looking at them and going, now, like I said, I think there's plenty. I don't think you need to just sell US assets writ large. I think you need to be choosy about it. But I mean, Tesla, same thing. Tesla's been a crazy story for a long time. But when Tesla was a crazy story and it had of all of us pulling out its hair years ago, it was growing at 40% a year. That company's contracting. And you could remove the tariffs right now. It changes nothing for Tesla, right? The tariffs have nothing to do with why they're struggling. They're getting their lunch handed to them by BYD. That's why they're struggling. Now, I think, you've added some pressure because of politics and things like that. But I think the media is even making a bigger deal out of that. BYD is why. Now, the other thing, everything bolstered Tesla's profit price. Full self-driving. Well, Waymo currently owns 100% of that market, right? I just think that there's so many of these things that retail is buying out of muscle memory, and I do think that we're about ready to get retail smoked.
And it sounds like there's no moat there with a lot of the businesses that you just mentioned. I mean, I know Elon Musk is trying to go into humanoid robots because that's where a lot of the Chinese manufacturing factories and electric vehicle operators are also going into humanoid robots. So he's transitioning to building those out too. But there's no guarantee that they have a moat there or high profit margins too.
Well, the other thing that you got to consider is if I was Musk and I'm looking at the realities of Tesla as a business, I honestly think that Tesla's business model is in serious trouble, meaning they cannot compete with companies like BYD at the low end. Okay. And Tesla does not work at the way it's currently constructed if they're just selling high-end cars, right? I mean, think of the money they've invested in the infrastructure for cheaper cars. Go look at some of those BYD cars compared to a Model 3. I mean, way better interiors, longer ranges, faster charges.
Well, I heard
cheaper.
Mark Andreessen said that they can make, I don't know if it's BYD, but one of the other Chinese motor companies, they can make basically a Porsche Cayenne electric vehicle hybrid thing. They can make it for like $30,000, he was saying, but
Yes.
it's blocked here in the US. That they can make like a legit exact copy of a Porsche Cayenne with better electronics for around $30,000. That's the turbo SUV, like a hybrid.
Yeah, and then BYD just announced their new battery technology where they can get 300 miles of range out of a 5-minute charge. Okay, at a significant discount to Tesla, anything Tesla offers. So if I'm Musk, I'm seriously thinking about whether Tesla is the corporate entity that I want to roll the robot thing out into.
Well, right, because that's what he's saying on the tech podcast. So all the messaging on the tech podcast, when he goes on and his friends are talking about Tesla, they're saying that like 5 or 10 years from now, the electric vehicles will be the smallest part of Tesla's business. They repeat this like nonstop.
Oh, well, I agree. I agree with them. I don't agree with the reasons why they think that's going to be the case. But I mean, and look, I don't wish Elon Musk at all. I actually tip my cap to the work he's done. I actually think it's largely been good. Certainly the reasons and motives behind it, I think, are good. And I'm glad somebody's looked into fraud and waste. I'm not grinding my axe against Musk. I have plenty in the past, but this is nothing personal. I'm just looking. You just look. I mean, what wasn't it? It just amazes me that investors are looking past these numbers. I think it was the UK. Their auto sales were down 65% year over year. Okay, when you see numbers like that, man, you can't just look past that.
Well, the market's saturated with electric vehicles. That's what it probably tells me, that all the buyers in Europe, European Union, UK, a lot of other that would have bought a Tesla, they've already bought.
Yes, yes. And so not only are you saturated, but the competition is 10 times what it was. Right? I mean, 4 years ago, Tesla was what? Would you have 26% gross margins in it? Now you're looking at like 8.5%.
So you're saying that there's other entrants, other electric vehicle operators are in there. And so there is an electric vehicle market. It's just Tesla doesn't have market share and they don't have growth. So the market is saturated with Teslas. And now people, when they buy their next electric vehicle, they're not necessarily going to reorder Tesla. They're looking at competitors.
Yeah, well, I mean, okay, so Musk is going to lose some people that would re-up on an electric vehicle because they don't like him because they hate Trump, right? So you're going to lose those guys. the people that want an electric vehicle purely for economic reasons and want the cheapest one they can get, you're not going to get those guys because they can get way cheaper offerings and even better appointed through BYD. I just think they're up against it. And I don't understand when you look at the legacy costs and the legacy investments and how asset heavy Tesla's business model is. I just, and maybe Musk has a grand plan. I'm sure he does. But my first thought was if I thought the robot business was going to be as good as it was, I don't know that I'd want to roll that out underneath Tesla's corporate structure. Because first of all, the logical leap that these people are all making is really bizarre to me, right? Like if you listen to them talk about FSD, full self-driving, it's like Tesla still owns that. And you go, they don't own any part of that business, guys. Waymo is taking that over by the handfuls. I mean, they are spreading fast, and they already have better tech than Tesla. So already this crown jewel that everybody thought was going to be this multi-trillion-dollar business. I mean, Tesla's coming from behind now. Period. End of story. Right. Then you start. You look at all the other things that they promised, and Tesla to me is laughable here. I mean, I wouldn't, if you got it down to maybe like, the $300 to $400 billion market cap range, Musk is not a guy I want to bet against. I might take a shot there, but I mean, at 1.1 trillion for a shrinking automobile manufacturer that doesn't have a robot to sell, and is getting their backside handed to them on the FSD race. Look, people are buying that stock because it went up a lot. That's it. They're going to get cooked again. And I'm kind of hoping probably one of our best trades over the last 3 months over the last year has been Tesla. We shorted it at 403 and I think we covered it at like 240, 230, something like that. We made some money running it up on the long side before that, and we've been kind of using it as an ATM. But I mean, we're not short right now just because, I mean, when you see a stock rally like that off of the disaster earnings it just put out, you kind of get out of the way. But, if you can get that price target up to 400 again, I would be thrilled to get another opportunity to short that thing from there. It's always been a ridiculously overpriced company, but when it was growing at 40% a year with 27% gross margins, it was way overpriced and ridiculous, but you could at least understand the narrative. It's now shrinking, right? Its margins, look at the last, so go back and look at how Tesla was doing the last time when they hit 1.1 trillion in market cap for the first time. Then go look at how they're doing today. It's laughable. It's laughable.
Well, I think the rest of the other tech companies are more interested in investing into data centers, artificial intelligence software. Elon has a separate company, X and XAI merged the two. So he has his play there. He's talking about starting a video game company with that. So the rest of the tech sector, the large tech companies, they're not into electric vehicles. I think you mentioned Waymo. Waymo is, I think, owned by Google, or Google owns a chunk of it. I don't know if they spun off. So that's the full self-driving. What Waymo's working on, robo-taxis in LA, and they have it in a number of cities, 4 or 5 cities now, major cities.
Yeah, they're all over Vegas. It's pretty crazy. I was down at CES with my wife this year and pull up next to an intersection, and you look over and there's somebody sitting in the back seat getting an Uber ride, and you look, there's nobody in the front seat. It was a trip. Yeah, so they're all over the place. The safety record has been outstanding so far. I believe, if I remember correctly, they're opening up Washington State, I believe New York and Florida as well. And I want to say they're increasing like 250,000 rides a week is the growth rate right now. And Guy, I mean, look, I'm sure Trump is going to help in any way he possibly can, but Tesla's not even approved for that yet. So, and their tech isn't there yet. I mean, they're not at Waymo's level. So I think they're still at level 3 FSD, where Waymo's at 5. So, it's bizarre to watch the growth story completely evaporating and people running the stock up at the same time. and off of, a robot, right? Like if anybody could pull it off, it's Musk. But I mean, the market's already, he's got a $1.1 trillion market cap in a company that's shrinking. Automobile company trading at 185 times earnings. I mean, it's absurd.
Now, Zach, we got to wrap it up here. We've been speaking for over an hour. I didn't get a chance to talk to you about big tech and investing in data centers and artificial intelligence this one, so we'll have to have you back on again the next month or two for an update on that. But overall, I think like the contrarian plays, as you highlighted here with some case studies, emerging market companies, there's a lot of undervalued growth stocks there that are like basically low price to earnings ratios. There's good businesses. Commodities plays, you have a lot of the gold stocks that are generating free cash flow, and then conventional energy there with oil, natural gas, and coal. That the whether it's bad policies with ESG or value investors or pension fund managers, they just don't want to touch a lot of these companies. Well, if the companies keep generating free cash flow or growing dividends and stuff like that, they have good financial good financials and good fundamental improvements. They're going to have to get recognized at some point, or they're going to get bought. The companies, if the assets are that good, there will be mergers and acquisitions then, because a larger company will buy the better small company.
Yep. I think that we are returning to a place in time where once again, fundamentals and cash flows do matter. And I think a lot of investors are going to learn that the hard way. But then I think a lot of investors are going to be able to take advantage because, like I said, it's not just, I don't want to just sit here and say, it's all about US markets being unattractive. I think there's plenty of good things in US markets. They're just not the things that everybody owns. But it's more about the generational opportunity that I believe exists outside of the US just because it's been neglected and it's been forgotten. And when I can buy great companies that have great management teams that are growing at 15 to 20% a year, and I can buy them at a discount to net asset value, sign me up.
Please tell my listeners more about your company, your asset management company, and Know Your Risk Radio.
Yeah, so Bulwark Capital Management, relatively small firm, managed close to $1 billion. I think we're at about 850 million in total AUM. Pretty small shop, have about 18 employees. We are active managers. We have two main portfolios. We run a value portfolio and a momentum portfolio, an algorithmic momentum portfolio. And we're operating out of Washington State, just south of Seattle. And you can get us at bulwarkcapitalmanagement.com or follow me on Twitter at KYR Radio. And then we do our podcast that we actually run daily, do a show called The Daily Dots, kind of wrap up all the important market and economic news of the day. It's usually about 30, 35 minutes. And you can get that at Know Your Risk podcast on YouTube, or go to knowyourriskradio.com to subscribe to the channel. And yeah, we're not hard to find. Just Bulwark Capital Management and Know Your Risk Radio.